right. Well, um, Christy has stepped aside, so I want to welcome everybody to the third Thursday marketing meeting. This is one that I'm particularly excited about, and we are going to talk about fertilizer, which is something we mention briefly occasionally, but we really don't dig deep. We have got a couple of guests with us today. We've got Alexis Maxwell from Bloomberg. She's a research director there. She's going to tell us a little bit about what's going on from a supply and demand standpoint, a pricing standpoint, where we've been and what the future looks like. We're also joined by Tom Torretti. Tom will be hopping on here shortly. Tom is with Cooper Consolidated. I've had the privilege of working with Tom in the past, and he's going to tell us about how logistics has affected the cash markets. So without further ado, we're going to kick things off, and we're going to start traditionally. Sterling's going to kind of walk us through the goings on in the corn, beans, wheat. He always mentions, and we might also talk about cotton. Now, if you remember, this is the guy that thought maybe we'd have a triple digit cotton number. So he always likes to bring that up a little bit. I was talking to a cotton farmer yesterday in Virginia, and his yields were almost double of last year. He really likes that 105, 106 price that he's seen. So Sterling, your prediction has come true on cotton, and some folks are really enjoying it right now. Tell us what's going on in the marketplace.
Well, right now, today we had our export sales report, and we're going to start today with the good news. We saw a really good number for soybeans, 2.8 million in sales. Best number we've seen in almost a year. Export sales for corn were great. We're at 1.2. That was above expectations. Both of these were above expectations. The best news, though, is, again, our friend, the fluffy white stuff, the cotton. Huge export sales, and I haven't broken this down yet, but good numbers out of the old crop at 391. Solid numbers for this time of year for next year. We're seeing China in here buying a lot of cotton, and that is going to continue to be supportive to the market. Now we're going to go ahead and turn and take a look at prices a little bit, and we'll go ahead and we'll start with cotton here. We're going to go ahead and change this over, and we're going to look at what the cotton market's been doing here of late. And we did see a price peak come in there. And we're seeing some weakness coming back in the market. We had seen a lot of fun buying in cotton. That drove the market up. We're still pretty close to life of contract highs and record highs up here. So I think we're seeing some profit taking by our friends on Wall Street. These inflation ideas, cotton has a tight correlation with the stock market. And we're seeing a little bit of behavior that was a little disconcerting. I know we had the big rally last week and the market shot straight up. The only thing that scares me more than a big decline is a big rally in the stock market, and that may create some nervousness here in the cotton market. So while I think prices can stay elevated, we may very well have put in a near-term top with the cotton market. So if you don't have some stuff locked up, they're ringing a bell for you. And looking at the more popular corn and wheat here, this will start with soybeans. The soybean market, as you can see, we've been in a steady decline. The soybean market needs to find some new bullish inputs. It needs to hear some news about some bad weather in South America, and it needs to hear that desperately. While we're seeing good sales, they're in line with last year, so they're not exceptional. It's not enough to lift the market by itself. And there is some history of fun buying this time of year, but it needs to be tied to some risk. They need to have some motivation to do this, because if we were going to see, if you notice, most of the commodities, the stock market, most of that stuff is printing red today except the dollar index. That's a sign of risk-off trading, and we get that. When that happens, a lot of times we see a lot of fund liquidation. That can drive prices lower. So while we've done a little better for the last week in the soybeans, we're not setting the world on fire by any stretch of the imagination.
Sterling, can I stop you right there and ask you, let's talk about soybeans for just a second, because just nearly every one of our listeners is in a soybean type market. We've seen some big changes over the last 6 months as far as projected carryouts, and we talked about in the DMO. I know I say it too much, but to bet against low prices is to bet against the American farmer, and it certainly looks like these yields, as they've crept up 51 bushel per acre, 51 bushel and change, it's putting some pressure on the cash markets. Everybody on the call can see it in basis right now. Basis is a really good indicator of supply. There are some basis opportunities still out there for December, January. If your customers are putting beans in the bin, I think you've got to take a look at those right now, because like what Sterling said, we've taken this carryout situation from maybe 120 last year, 120 million in our leftovers that we were going to end the year with. All of a sudden, Sterling, what are some estimates for next August left in our bucket? How many bushels are we talking about?
Well, when I talk to my buddies in Minnesota, my buddies downtown here, and my buddies in Geneva, the number 500 gets kicked around pretty much. That is becoming kind of a common idea. We had the big bump in the carryout because our quarterly stocks number, and we didn't use quite as many soybeans as we wanted to.
You guys hear me?
We would.
Tom, I think we've got you on here. Yeah, I can hear you.
And anyway, that combined with the fact that we know soybean yields tend to get better as we move through harvest, and harvest is moving through pretty quickly, it's entirely conceivable that we're going to see, that big carryout, and that is going to come in here, and that is going to weigh on prices. And unless we see something in South America, because right now the projections are they're going to have a record crop down there. And I'm talking, 140 million metric tons. So if we see that, that is going to create a situation where there's going to be plenty of pressure on these soybeans.
Looking at futures market, if you read the DMO last night, we're seeing a carry form up across the board. It's been a long time since we've seen this kind of carry, meaning that this November beans have a lower price than next November beans. What's that telling us, Sterling, that the market sees?
Well, here, we'll go ahead and we'll demonstrate that. And what we can see, and we'll see here the prices for this year and next year. Right now, we're looking at November new crop beans, $12.38. So they're just a smidge higher. And we're looking at November beans at $12.35. Right now, I think the market is kind of pricing in a state of normalcy, that we're going to see things at this current level where we're at, which is right now about a 280 carryout, give or take. If we see that carryout elevate, that's going to push this whole curve lower. And right now we're in prime time for soybean exports, and this is going to could create a bit of a hard time if we see that good crop and we start moving beans out of Brazil in January.
So we've really got to keep our eye on Brazil, and we've got to hope for something that really rarely occurs. If you remember last year, we started off very dry. The map stayed at a deficit throughout the growing season, but Sterling, we seemed to get just enough rain. While it wasn't a great crop, it was certainly not a bad one. So when we bet against problems in Brazil, we are betting the very low percentages there.
You are trying to think that we're going to have 2 years in a row of bad crops in South America is kind of a sucker bet. The fact that they've increased acreage. Every year their technology gets better down there, so their ability to produce continues to get stronger and stronger. So this idea that we're going to see 2 droughts back to back is probably a pretty dangerous wager.
How about corn? What are we seeing there? You got anything brighter to tell us in corn?
No, I don't. I wish I did, but I don't really. Corn is actually held up on a relative basis versus beans a little bit better. The best news about the corn I already put out. The export numbers, the export sales numbers were really good. We saw a lot of the sales this week went to unknown destinations. Normally, that means China. So if we have China in here buying more corn, that will be helpful. Keep in mind, last year China bought and imported a ridiculous amount of corn, and I can show you a chart of that here real quick that really illustrates what went on with China. We can't really depend on that happening year over year and that happening all the time. So if we look here at the actual exports of corn to China, which is really at the end of the day the thing that matters, this green line was last year. These lines down here are all the previous years. As you can see, we really blew things out. This is where we are right now for this year, where this red line is. So while we're not as bad as we used to be, we're still not keeping up with where we were during the biggest boom period. So the USDA thinks we're going to have, tremendous and really good exports, but thus far we're doing good. But that's a situation that can change, especially if we see good production out of South America. The crop problems that happened in Brazil centered more around the corn than they did about the soybeans. Proportionally, they lost a lot more corn, and that's what precipitated this. One other little piece of good news, I don't normally cover this in the Export Thursday report, but I'm going to start adding this in. Our soybean meal exports have been off the charts. Those have been really good, so that is one thing that can kind of help the soybeans. Along with that, there's a lot of refined fuel talk. We've seen bean oil prices go up, which is a little surprising because the talk and all this actually happening is, you know, down the road a year, 2, 3. So I think we may be getting more of a knee-jerk reaction there, but that's something that could help out the soybeans in the longer term. And
you hear
let's
me?
go ahead.
Tom, we can hear you. Sterling is presenting right now, and we will probably pass the ball off to Sterling, Mike, then Alexis, and then circle back to you at the end. Hopefully our audio visual is squared away by then.
Okay, so let's see. We already talked about cotton. Let's go ahead and here's the one thing where I do have some good news. I have good news about wheat. Generally speaking, global supplies for wheat, and particularly quality wheat, have been problematic. And so far, of all the charts that I've shown, this is the one that still looks the best. We're seeing very good. We have very good prices for spring wheat here, and this is helping. I mean, we're down a little bit today, but generally speaking, if these prices can stay elevated, that will serve to help the row crops. On the other hand, we're going to be talking about input costs here pretty soon. And if we know input costs are too high, that could mean maybe some acres find their way into wheat where they can. And that's something that could work against us. But right now we have a global situation in the wheat that is working to help everything.
I've got my volume all the way up.
Okay.
Christy, you might mute Tom for the time being, and we'll continue on, and hopefully he can get things squared away.
And we'll throw in 3 quick global macro things here. First, we're going to look at interest rates, which guess what? When we talk about input costs, we always talk about, fertilizer and things like that. Cost of money is an input cost as well. And that's something, again, right now we don't really have a problem, but something we need to think about. As you can see, interest rates have moved up, and they're continuing to move up. And there's ideas about the Fed easing. If these move up, if you need to lock in a line of credit, my opinion would be probably best to do it sooner rather than later to take advantage of these lower interest rates. And we'll start talking about the bad news here. Take a look at crude oil. And it's down a little bit today. Imagine that. That happens occasionally during the day. It doesn't usually finish lower, but you can see here, price of crude oil has moved up noticeably. We got some inflation numbers a week ago that sparked this stock market rally. Those inflation numbers did not include this recent rally in crude. So the next go around, those inflation numbers are going to be there, and they may be a little bit scarier than what we saw just a week ago. Anyone have any questions? You want to take a look at natural gas? Or?
Well, I don't think you can hit us with much more good news here, Sterling. It's about all we can handle. It looks like inputs up across the board, and of course, that's what we're going to concentrate on is fertilizer, because fertilizer is probably the biggest percentage of our inputs overall outside of land costs. But you guys get the picture here. We talked about seed a little bit earlier. If you were on here before, Alexis and I were talking about chemical a bit, but we're starting to paint a picture where the tide is turning, and we're officially saying that. It certainly looks like the tide is turning as far as supplies go. We're coming out of a year that could possibly provide some record revenues per acre, and we're heading into a year that it looks like certainly we're going to have some record expenses per acre. Sterling did a great job of kind of telling us where we're at in these marketplaces right now. The bottom line is let's really take a look at some of these cash prices that are out there for December, January. I think it's a good combination, even with the price structure we've got now and the yields, to be able to lock some really good profits in there. Sterling, any final thoughts on the commodity markets as they are right now?
No, we do have some risk off behavior happening. The stock market has gotten itself into a curious place. We had that big intense rally that took us right below record highs. Markets are most vulnerable to sell-offs when they come up near a record high and start to back away. So if we were to get any sort of squirrely input, this market could easily take 4 or 5% back that it put in the last week, could take it out at a blinding rate of speed. And along with that, we're starting to see, again, our old friend the dollar is, while we've been down for the last week or so after those inflation numbers, the general trend is higher, and we're working a little bit higher today. If we were to see a risk-off event, we could see the dollar higher, and that could serve to fracture prices on the board.
Well, Mike, I appreciate you hopping on here. I know it's been a challenging week for you, and it's good to see you. Good to see you out and about. Tell us what's going on in the world of agronomy right now. What's an agronomist look at in October?
Yeah, do you want to grab my slides, Christy? Is that okay? We'll run off those if we can.
In there, I'll pass the ball off.
Sterling, thanks. An awesome job as usual.
Sterling.
No problem. I'm glad to see you're doing better, Mike. I'm sorry about your loss.
Yeah, it was a beautiful day yesterday, so thank you, Sterling. There we go. Thanks, Christy. Closer. All right. Thanks, Christy. If you want to wreck back to the title slide, thanks. I'm just going to talk a few minutes here this morning. I think the number one thing talking to my customers is, number one, we want to wrap up the harvest and get the crop put to bed. But right now, a lot of really good discussion going on about what are we going to do about our fertility, nitrogen, P and K, and that's what I'm going to talk about today. And also kind of look ahead to harvest weather. Looks like we have a pretty good run for the next 3 to 4 days, but there is a very wet system coming in this weekend, and I'm afraid we're going to have additional quality issues throughout much of the Corn Belt. Next slide, Christy.
Mike, while she's changing that,
Perfect.
just to clarify, you think that the standing corn and this moisture, you think you're going to suffer some test weight and possibly damage issues? Is that what you're saying with the damage in corn?
Yeah, what we've got now, Brooks, roughly the 30% of corn left in Central Illinois, it's about 2 foot tall, and it's going down. And most of the fields around here, the second crop, we probably left 5, 6, 7 bushels in the field, and we're going to have more additional losses. And on the soybeans, what we've noticed, Brooks, after they were dry, got down to 8%, they jumped up to 13, 14, they're back down to 11. Most of the test weights in the beans are running 3, 5% off. So we're losing some bushels in the field due to test weight. And it looks like to me, we're going to hit them as hard as we can, but we're going to soak them up pretty good again this weekend. Then it's probably going to be another week to 10 days. So by the time that soybean, the biology, it goes from wet to dry to wet to dry to wet. There's just never as many bushels in the field, which maybe could help us a little bit on the supply situation.
This last half of harvest is going to linger, isn't it?
It sure is. So thank goodness we've got some really nice weather here for the next couple of days, and hopefully they're going to be wrong about the weekend system, but they're talking 2 to 3 inches here for Central Illinois, which pushes us behind and makes everything a little bit rough. Kind of the number one thing on most farmers' mind, not only here in Illinois, but throughout the Midwest, is just look how fast our fertilizer prices have risen in the last year. I've got the current DTN retail fertilizer survey. This has got a little date to it. The latest survey was October 4th to 8th. And notice our dry materials, DAP is up. It looks like roughly 80%. MAP, about the same. Potash almost doubled. And the same with urea. And unfortunately, most of these prices are already way too low. They've had a nice increase over the last 7 to 10 days. So it just seems like we can't catch the tail on these rising fertilizer prices. Can you get the next slide, Chrissy? We'll talk about the liquid products. Yeah, looking at the same, right now, looking at ammonia, which will be the number one input that farmers will be looking to apply here. The ammonia price this time last year was $4.24 average retail. Right now it's $8.03, and I talked to a few buddies who don't have their nitrogen booked, and it's over $900 here in Central Illinois. And looking ahead to next spring, Uran is already a pretty expensive source of nitrogen. We went from $209 this time last year to $400 today if one can buy it. So these fertilizer prices are very scary. And again, most of these products are already too low. And this data was just from October 4th through the 8th. Next slide, Christy. What we're thinking about with these higher prices, this is a pretty nice little tool. You can access this from Iowa State. Illinois also has a calculator. What this little tool allows you to do is pick your state. It's got Minnesota, Wisconsin, Michigan, and Illinois, Indiana, Ohio, and Iowa. And you can pick your part of the state and also pick your nitrogen source and your prices and add in your price of corn. It gives you a pretty nice little calculation based on a pretty good database. Next slide here, Christy. What I've got here, using our current price of $8.03, which I think is already a little bit low, and I've got $5 new crop corn for 2022. And in this situation, we're going to be using ammonia on bean ground, and you apply the numbers into the calculator, and the optimum rate based on almost 290 trials is 182 pounds, and the price of that ammonia is $89.18 per acre before we have application costs. So again, that price has almost doubled for farmers just here in the last year. Next slide here, Christy. This is a more expensive source of nitrogen. We're using a lot more of urea in some spots, but primarily my part of the world would be ammonia or 28% nitrogen. And the price of 28% of $400 a ton is 71 cents per pound. Based on the higher price of nitrogen, our optimum rate drops down to 167. And look at that price tag on that, $118.57 for 167 pounds of N. I've been doing this for a lot of years, and I don't think I've ever seen a number that high. In my opinion, based on the last couple slides, it's going to be pushing probably a little less corn on corn and maybe some more bean on bean acres in the southern part of the state. And my last slide on nitrogen, Chris, if you can grab it for me. We'll look at corn on corn. I'm using my 803 for the ammonia, $5 new crop corn. For my corn on corn, the rate jumps up to 200 pounds per acre, and the price is almost $100, $98 per acre. So again, that's the number one thing farmers are talking about to me right now is, can I find my nitrogen, can I book my nitrogen, and can I afford to do a lot of corn on corn based on the current prices? Next slide, Christy. Got a little more fertility talk here before I go into weather. This is a nice little tool off the Mosaic site. It allows you to select your crop. You can pick up to 8-9 crops here. And I just picked corn at 210 bushels per acre, which is a pretty fair yield for most of the better soils throughout the Midwest. And just to replace my P and K only, my cost based on a current price of $7.36 DAP and $6.75 potash is $88.32 per acre. Again, just a very high cost. And my next slide, Chris, may surprise a few people. Everybody think that soybeans don't take nearly as much fertility as corn, but just 65 bushels of beans, they use a lot of potassium. Our fertilizer costs are about the same, $82 an acre. So again, everybody thinks soybeans are free as far as fertility. That is not the case. There was just an $8 difference based on today's prices between corn and soybeans. Next slide, Christy. I just threw one quick slide here on winter wheat. I did not put a double crop price on it, but the wheat is a little less costly from a fertilizer standpoint. The straw is staying in the field, so we're around $38 for just the 70 bushels of wheat, and the straw stays in the field. Before I go into weather, Brooks, any questions about fertility for me?
No, I think you analyze that nitrogen application pretty well, and there is a trend, for the folks that are trying for those higher level yields. You may be even a little low on some of those applications in some parts of the country. So you're erring on the side of caution, kind of a bare bones program for a lot of folks. But when we didn't talk about starter fertilizers, we didn't talk about the heavy use of nitrogen. So there are some cases, in a lot of cases, when we take our P and our K and our N and we look at it on an average acre in Illinois, there is a really, really good chance, throw in starter, that number could be 220, 230 per acre. Is that out of the question?
No, that's very fair. These are just based on the maximum economic return for nitrogen. Most of the high yield farmers are going to be using nitrogen race, at least based on last year's prices, 30 to 40 pounds higher. And our starter fertilizers have also doubled too, Brooks. So again, I think what we'll see for next year, if these prices hold, you're going to be more efficient, probably a little less fall ammonia. And on those ammonia prices, we did not price in the cost of insert. We have to have another $10 per acre to it. So Guys
Right.
will be watching their pennies a lot more closer for next year. I want to grab the next slide.
Yeah.
I just got one more on fertility here. We're getting this question asked a lot too. What if I skip my P and K for a year? If you got medium to high testing soils, you're probably not going to miss the P and K for 2022. But one thing that Brooks talked about earlier, and also Sterling, most farmers for the 2021 crop are coming off record income levels because they had good prices, good yields, and lower input costs. We've got some pretty major tax implications if one skips that P and K. So again, good fertilizer discussion. I'll just wrap it up on weather here. I'll get the meeting moving along. Can you get my next slide for me, Christy? We've had a really good week here in Central Illinois catching back up, but there is a very wet system heading in for this weekend. That's going to affect basically Iowa through the eastern Corn Belt, and middle of next week also looks pretty wet. So again, we've got a very good crop, probably a little less than expected here in my part of the world, but I'm really worried primarily about these soybeans taking on water one more time. And again, driving through the fields yesterday on the way down to DeWitt County for the funeral and back to the farm in McLean County, the average standing cornfield was about 3 to 4 foot tall. So a lot of potential loss here, and not expecting a lot of wind here, but we do have more issues as far as the heavy rain. Next slide here, Christy, for me, please. And looking out a little bit further, these are the maps from yesterday, but the 6 to 10 continues the wet weather, which pushes us very close to November, and 8 to 14 also. It's going to make that last bit of harvest pretty hard to obtain. Again, it's been a very good harvest season, but the last 20-25% of it may be a challenge for us. And looking ahead to fall ammonia, Christy, for my last couple slides here. That's our soil temperatures as of yesterday. You really want to keep that soil temperature 50 and below for a long period of time before we go with fall ammonia. And right now, soil temperatures are above the optimum for fall ammonia in most parts of the Corn Belt. And my last slide here for me, Christy, if you would, please. Looking at the 6 to 10 day temperatures and 8 to 14 day temperature outlook, it looks like a very warm period. And agronomically, it doesn't look like it's going to be very sound to be putting ammonia on until November. And what happens if it gets wet and we can't get the ammonia on? It's going to make that spring bottleneck even tighter. It's going to make the supply situation even tighter. I'm afraid it's going to probably push fertilizer prices a little bit higher. And I can't wait to hear our experts talk about their opinions on where these fertilizer prices go heading into spring. And that will do me.
All right. Well, thanks, Mike. Next up, we've got Alexis. And Alexis, no pressure. You see, we painted a very rosy picture for you to step into right here. So, Alexis, if you don't care, you're going to be new to a lot of our viewers on here. Tell us a little bit about yourself, where you're located, what you do, and then tell us all the good news you've got to tell us about fertilizer. We're waiting on you to deliver the fertilizer good news.
Brooks, thank you so much for that rosy introduction. I wish I had content that was just as rosy, but I'm unfortunately get to go a little bit deeper into these higher fertilizer prices, and I don't have a lot of great news to share on where we're going to go over the next 3 to 6 months on these fertilizer prices. Thanks for having me on today. Just as a brief background, I'm with Bloomberg. I do fertilizer research for the company, but I've been in the fertilizer space now for about 10 years, worked for some various producers doing market research prior to coming here to Bloomberg. So I am also from Illinois, born and raised, and now I live down in Houston, Texas. So some of the stuff I'm going to talk about here with hurricanes and the natural gas freeze making these ammonia prices higher were a little personal. I'm going to jump right into it here. As soon as y'all can see my screen, it's going to be good to go. All right, so we aggregate all of our NPK prices into one index to get an idea on how fertilizer prices have been performing. And looking at where our North American fertilizer price index is right now, we're at the highest on record, going all the way back to when we started this index back in 2002. These prices even exceed the index level that we had in 2008, which is the last time we had fertilizer prices where you had a 1 in front of your 4-digit ammonia price. And that was back in the financial crisis. But this time around, it's a different scenario. It's not really the economics of the global macro picture that's driving up fertilizer prices. It's a lot of perceived and actual shortages across the NPK complex that are pushing these prices up, as well as just a really good year for demand for fertilizer on the backs of high corn and soybean prices in 2020. It's not just one fertilizer that's driving up these prices. Our DAP, potash, urea prices have all almost about doubled since January of last year. These are prices here in the Corn Belt on the wholesale level. We've got urea today at $8.40. You've got your DAP at $7.50 and potash at $7.30. So really sharp increase in a short amount of time, and that really kick-started in about January of 2021. So I'm going to first talk about the ammonia story, what's happening in that market, because now that one's really driving an increase in subsequent downstream products. But so 2021 was a year where we had a lot of unexpected outages. At one point in the first quarter of 2021, we had 12 world-scale ammonia plants go offline for unexpected reasons. A big part of that I mentioned earlier, we had some weather in the U.S. in February. The snow that came down to Texas and Oklahoma forced some plants, pushed some plants to go offline as they sold their natural gas into the domestic heating market. And so we were a little short on supply on ammonia heading into September. And September was a pretty bad, it was a poor opportunity because we had Hurricane Ida came through the Gulf, and that hit 5 major U.S. domestic ammonia producing plants. CF Industries, Nutrien, Waggaman, and Mosaic all reported outages at their facilities down in the Gulf, and we reckon we took about 200,000 short tons of ammonia production offline during that period. And while all that was happening, we had a really strong increase in the price of natural gas for some global producers for ammonia. So on the right-hand side here, we've got the UK natural gas price, and I don't think you could make that any more of a straight line if you wanted to. We saw prices, this increase in prices going up from trading around $5 to $10 in the second quarter to $25 to $30 today here in the fourth quarter. That price increase really put the pressure on ammonia producers in Europe. So the way that this works is they produce ammonia on 33 MMBTUs of natural gas. So 1 ton of ammonia will cost you the equivalent of 33 MMBTUs of gas. So altogether, when gas is, let's say, $21.50 in the UK, your cash cost of production is going to be about $750. And at the time, that was about $100 higher than the prevailing price for ammonia. So we just saw producers across Europe on the ammonia side curtail their production. We think that we lost about 40% of Western Europe's production capacity. And looking out into the next quarter and through the winter, it's going to be really difficult to fix this price problem. So there's a lot of factors into why natural gas prices are high in Europe, but it's primarily due to an over-reliance on imports. They have been transitioning away from coal into more renewable energy sources and using natural gas as the bridge to get there. Well, this summer they had some issues with their renewable power generation. They didn't have as much, so their demand for natural gas increased significantly. Also, Europe has been searching around to buy new natural gas wherever they can find it. It turns out that China is competing for natural gas. China's snapping up any type of cargo that's coming out of the U.S., which means Europe has to turn to Russia to get any additional supplies. It's a very extremely tight market, and there's a lot of politics happening in this market too. You've got Russia, who could supply more to Europe through their Nord Stream pipeline that's supposed to turn on in January, and Russia is pushing Europe to go through the appeals and process to get that pipeline turned on, and Europe has been resisting a little. So a lot of politics, a lot of energy at play here, but the net is that we don't have as much ammonia in the fourth quarter as we had expected, and so prices rose in response. You saw Corn Belt ammonia nearly double in anticipation that we're not going to have enough to go around. So, taking that to the farmer, what does that mean? Here, gosh, I should have used this slide a little bit earlier, but this here is a look I think you guys are all going to get the slides later, so maybe you can take a look deeper. But this is on the left-hand side, we've got to look at capacity for ammonia globally in 2021. And I've got in those bright neon colors, Central Europe and Western Europe. They're not a big part of the world. They're about 9% of total capacity. But they were the high-cost producer on the ammonia cost curve. So when we are short ammonia, we would expect to make prices rise so that the high-cost producers will turn on and add additional supply to keep prices in balance. Well, that's not happening because of natural gas this year. And at the same time, I can't believe I haven't mentioned China yet. So China is the marginal producer for nitrogen fertilizers, and they have their own energy crisis heading into this winter, too. They've had a shortage of coal. They're trying to buy as much natural gas as they can. If you remember last winter, they had a very cold winter. They didn't have enough to go around to keep their people warm, and they're trying desperately to prevent that happening again this year. At the same time, all of their industrials are up and running after many COVID shutdowns last year, so they just need more energy. And what they're doing is they're trying to keep all of their energy molecules in the country. And that has an implication for nitrogen fertilizers because they produce nitrogen from not only natural gas, but also from coal. So they're producing enough fertilizer to meet their domestic needs ahead of their spring season in March, April of next year, and they're not going to be exporting any nitrogen to the global market until probably June of next year. They want to make it through their spring demand season before they serve the rest of the market. So we're absolutely...
Alexis, can I ask you a quick question?
Oh, please, yeah.
I wanted to kind of interject here. So this is something we've talked about in past Third Thursday marketing meetings. We've kind of talked about, the media makes it sound as if China is withholding important fertilizer from the United States. I think you gave a really good explanation of exactly why we're not getting that supply. It's more about keeping those, like you said, energy molecules in China rather than, and using them for the basics rather than production. Is that correct?
That's how I'm looking at it. I think China's taking a China first policy. Keep the energy to where China needs it, and then anything else is a problem that they'll deal with later. So, for example, right now they've prohibited exports of 29 different fertilizers: urea, ammonia, UAN, phosphates. I could go down the list. What's interesting to me, the one fertilizer that they're not putting any export restrictions on is ammonium sulfate. Now, the production process for ammonium sulfate is it's a byproduct of steel and caprolactam production. So I think the reason they didn't restrict exports for ammonium sulfate is, well, that's not really an energy-consuming production process. It's just a byproduct. So since it's leftovers, you guys can sell that to the global market. But Brooks, you're right. This is definitely China wants to do China first and keep their energy in country. So, if we think a little bit longer term about implications for this, it will be tight on the nitrogen side all the way through second quarter of next year. But if they have leftover urea after their season, it could be that they dump it onto the global market in the summer, but that's pretty far away at this point.
Alexis.
Yeah. Hey, Tom.
China doesn't really, over the years, they used to bring that horrible quality urea into this country, and people don't even want to touch that anymore.
That's
and really,
right.
the only things that they brought in is sulfate. Everything else has remained there or went to other countries.
Mm-hmm. Well, you're right. But the problem that we're running into right now is, so we've got Europe is effectively out of the market, but those farmers still need product, so they're going to turn to places like Egypt and the Middle East to get their fertilizer needs. And at the same time, now it's fourth quarter, you've got Brazil and India who are trying to buy their nitrogen, and they want to also go to the Middle East and to China to get their supplies. But you don't have China in the market. So now you've got a situation where you have a very small, narrow number of suppliers and a lot of people who are interested in buying. definitely it's a supply shortage that's driving this market higher.
Right.
So I think the next natural question then is what's that going to mean for demand? So what I wanted to talk about a little more in what we think could happen here in this fall. I took our wholesale Corn Belt ammonia and urea prices and I converted them to a nitrogen basis. And I took urea less the ammonia spot price. And I took a look at the spread, and right now the spread is 23 cents in urea's favor. So even though ammonia's got these really high dollar per ton price tags, you know, right now Corn Belt ammonia is $1,000, $1,100 a short. Urea is still pricier on a unit basis. So what I'm expecting to see from farmers is looking at this relative value that ammonia has. It seems like a good opportunity to put ammonia down this fall if you can get your hands on it to meet your nitrogen needs, and then hope maybe that nitrogen prices fall a little bit here in the spring. And I think this is also going to have some downstream impacts on phosphate and potash pricing too. I mean, there's only so much space in a budget for your fertilizer needs. But you have to apply nitrogen every year. It's not necessarily the case that you have to do that with phosphate or with potash. Those are places where it's easier to cut a little bit. So we're in a scenario right now where ammonia is cheap if you compare it to urea. You know, taking a look at the fertilizer to corn ratios. Just using our Corn Belt wholesale prices to front month corn prices on a relative basis. Normally, we're basically at record highs. We're even higher than levels than we were at in 13. And the reason that 13 into 14 was we saw such high fertilizer to corn ratios was because corn prices fell after we had the drought in 2012 and $8 corn. So 13, we saw a halving of corn prices, and that contributed to the higher ratios. So this year, we're going to be setting records on the relative affordability for DAP, urea, potash, and ammonia. I spent a lot of time talking about what's going on with the nitrogen, and then needing to watch natural gas and seeing what happens with winter weather driving the ability to get ammonia production. But DAP is also short too. We had some changes in trade flow in the U.S. on the DAP side with Mosaic initiating a successful duty filing with the Department of Commerce. So that's restricted some importers from Russia and Morocco bringing products to the U.S. So we've been in short supply for both DAP and MAP, especially after Nutrien converted their Redwater facility to ammonium sulfate production. We lost about, I think it was 200,000 metric tons of MAP at that time. And potash, we're also short on potash, and mostly that's because we've had, again, some unexpected supply shortages. In Canada, we had Mosaic had to shut down their Esterhazy K1 and K2 mines unexpectedly a couple months ago. And then on the global side, we've seen both the U.S. and Europe enact some restrictions on trade with Belarus. Belarus is one of the world's largest producers of potash. They produce about 15 million metric tons a year, and the U.S. and Europe levied restrictions on trade against that country for political reasons relative to Belarus becoming less democratic and friendlier to Russia. Anywho, what that means is it's a little bit harder to get your hands on potash because Belarus accounted for about 20% of global exports on potash. So the perceived supply shortage is also driving up that product as well. I wanted to leave with one last look. I took a gander at what your corn cost of production might look like if you're a corn farmer in the U.S., what these fertilizer prices mean. Now, I'm going to say I did this about 3 weeks ago, and since I did this, we've seen ammonia prices come up about $300 a ton. So it's a little bit more of a worse story, but looking at a corn budget in 2022, I would expect, just based on prevailing prices in September, a corn farmer doing a normal application rate, like a 180, 6080, would spend about $166 per acre on their fertilizer expense. And just looking at your operating costs for a farmer, your fertilizer as a percent of your total operating cash cost is going to be about 43, 45%, probably a little bit higher. Normally, farmers, they spend about 35% of their cash expense on fertilizer. So a big increase. It's going to drive up your operating costs for corn 16% in 2022 if you made no other management changes. And earlier on the call, Brooks, we were talking about seeds and chemicals, and I took a look. This is USDA data, and I took a look at what they said, historically farmers spent on seed and chemicals on a per acre basis. And it looks to me like farmers have really trimmed the expense on chemicals and seeds. Back in 2016, a farmer would have spent, $36 per acre on chemicals and $98 on seed, and they trimmed that all the way down to $30 and $91 in 2021. So that tells me they've already trimmed some of the fat there. It seems ripe that we're going to get demand destruction in fertilizer, because it's going to be hard to find another place in the budget to make this work.
And not to be critical of the chemical number, because it's 31, to kind of give you an idea on my particular farm. Now, I've thrown fungicide and insecticide in the mix. I'm going to include some application costs. Obviously, I don't have my own airplane to put things on with, but in my neck of the woods, herbicide, insecticide, fungicide, and application will probably average around $85 to $90 an acre.
Okay.
Now, that's one snippet. Is it possible to get by if there's a lot of no-till in some fringe areas now? That's cause for increased herbicide costs versus the tillage tool, the fuel. There's always offsets out there. But the chemical is probably one of those, in a lot of cases, that universities probably lowball just a little bit. At the end of the year, when we start totaling up those costs, I think most farmers are amazed at maybe how much they put in to fertilizer. Where Mike Toohill's at, Mike's up in I call it North Central Illinois, but let's just say Central Illinois. 5 years ago, I would guess a fairly low percentage of the corn had fungicide applied to it. Now it's becoming something that's more mainstream. Also, lots of we're seeing a kind of a decrease in acres of dicamba beans. Dicamba beans offered a little bit of relief on the cost side. It came with some other issues that were out there, but we're seeing a bump up in those. At least I am on my farm, and I think a lot of farmers are as well.
No, Brooks, you said you thought you were going to spend, what, I think $81 this year? How is that relative?
Actually, 89 actually.
Okay, and how is that compared to what you did last year? How much are you up?
It's so from 2020 to 21, I can't tell you the exact figure, but it's not going to be that much. 2020 to 21, not that much. I would say maybe 4 to 5% overall. My guess is 22. We're looking at at least a 15% increase if I was guessing. And granted, I haven't even looked that far off into the future. A lot of farmers as well, unless they're applying themselves, and a lot of farmers do apply themselves, tend to buy that on a spot market basis. In other words, if your field needs to be sprayed, I'm going to call it in to an applicator, and I'm going to pay that spot price. We don't pre-book. If we're not applying chemical on the farm, we're not pre-booking a lot of that at a retail level, if that makes any sense.
Yeah, so I think these fertilizer expenses going to have a lot of people looking pretty hard at the P&L and considering what acres that they want to do next year. It's hard to see an instance where we're going to see a decrease, a significant decrease in nitrogen costs the next 3 to 6 months, mostly because a lot of this is driven by natural gas. We're going right into the winter heating season. So if we have a really cold winter in places like Europe, China, and the U.S., it's only going to, keep those gas prices high and those ammonia prices high.
So we need to hope for warm weather in China, is what you're saying. Our hope is in the weather in China. Yeah.
That's right.
Alexis, that's unbelievable information. I'm so glad you came on here. This is something a little bit different for our viewers. We normally talk about commodities the entire time. I really liked the chart you had on here, a slide earlier about the corn fertilizer ratio. And if you look back into 13, I think you talked about something that was really important. We all remember 13, 12, and 13. You can kind of see that in the very center of your chart. We came out of really 4 prolific pricing and revenue years in agriculture. We had 2008 through 2012 where the ethanol mandate kicked in and we had to get in high gear. We saw those corn carryouts go down to the single digit percentages, and all of a sudden in 13, even after a single year of drought, probably the worst drought a lot of us have experienced, we created a massive amount of carryout in corn. Now, the spike you made mention here, the spikes that we saw in 13 and today have 2 different reasonings behind them. In 13, you mentioned a cut in commodities, almost half the price of corn. Fertilizer might have stayed the same. I fear that this chart right here could actually be accentuated in 21, where you see these fertilizer prices go high in conjunction with commodity prices go lower. Do you think that's going to happen on this chart if you were to look ahead?
I think if we're going to want corn acres in the U.S. at the 93, 94 level next year, corn prices are going to have to respond to these higher fertilizer prices and drop that ratio. Because as it is, these fertilizer prices aren't coming down. So either corn's going to have to make up, or we're going to see farmers are going to cut back on corn acres, and it's going to be a battle. It's going to be really.
And for everybody listening, we've got farmers that we talk to, and a lot of times we're in that inner circle, and they come to us and they say, how should I prepare my acres for next year? More importantly, how should I spend my money in prepays at the end of this year? So for a lot of us, we've got farmers that saw some big revenues. It's going to be really interesting as to whether they invest in that fertilizer here over the next 60 days of the year to help them in a tax situation, or they wait. If they wait, Alexis, I think you're right. I think it's going to put those corn acres in jeopardy for next year.
Well, and I'm really interested to hear what Tom's going to tell us about the logistics side of the fertilizer space, because I don't know that I spent enough time or made this really clear. Prices are really high. It's very difficult to get your hands on fertilizer today. I mean, I'll leave it to Tom to give us a little bit of situation of what might be going on here on the river and in the interior, but it's short everywhere. These nitrogen plant outages really had an impact on fertilizer availability, and looking to the future, it doesn't look like there's going to be available supply from many places we used to buy from.
Well, Tom, that sounds like it's your cue. I hope we got our audio issues all worked out, and no pressure on you, man, but take us through the end of the meeting. Give us, and you got to end it with one. I know you're an optimist by nature. You got to end this thing with one glimmer of hope for us, okay? So just save that back for the end. So the screen is all yours.
So we are still having the effects of Ida down in Louisiana. As most of you may or may not know. Our stevedoring operation, we're delayed 5 to 7 days, catching up from ships that were en route or in the river. When Ida hit the Gulf, this hurricane was far worse than Katrina because it did more damage to the river than Katrina did. Katrina was more of a flood event. Fleet breakaways, sunken barges, sunken fleet boats. We're still trying to pick up after that. Pickup times in New Orleans on loaded fertilizer barges is anywhere from 5 to 10 days, depending on the fleet and the carrier. We cut the last date to load to St. Paul through La Crosse was last week. The 27th of October is the last date out of New Orleans going to Dubuque and south. We think we'll be able to get up there with no issues, but there is low water on the lower Mississippi River, and that will potentially, there were some groundings a week to 10 days ago down there. But it's something to be concerned about, and likewise the water level in the St. Louis area. Barge freight has been tight, simply because elevators, started up after the hurricane, those that were able to do so. So it was very much hand to mouth. We're still in a force majeure situation, both on barging and stevedoring. And hopefully that will go away by the first half of November. Spot barge freight went crazy on a couple, 3 fertilizer barges. And this is just for info's sake, but from New Orleans to St. Louis traded for $47 a ton, which that's normally on an annual contract basis at $11 to $12 a ton freight price. Going forward, I'm going to touch on some things that Alexis said. Imports of potash, urea, phosphates, MAP and DAP were up this year. Well, let me rephrase that. Urea was up, potash was up, MAP and DAP not so much, primarily because the OCP folks in Morocco and Eurochem have sanctions put on them by the government, and they can't make the numbers work. So that only leaves one Russian producer, Fosagro, to come in here, and they have a tariff on them as well, but not to the degree that the other two do. The only other places you're going to get potash from is Israel and Russia, and I do not think they will be able to pick up the slack that the Belarusian potash company historically brings in. The tariffs or the sanctions on them are on December the 8th, so they can only bring product in until that point in time. They have a ship en route that'll be in here over the weekend. But after that, that's it. They have a exclusive contract with Gavilon, and Gavilon is now searching for more supply, and where they're going to be able to get it, I don't know. The North American producers, Nutrien, Mosaic, Nutrien's going to ramp up production, but I think that's more so for domestic tons than anything else. So that's going to be a real problem on the potash front. On the urea front, we're the cheapest place to bring cargo in presently. So we're not going to see any offshore tons in the near term. One thing I've heard talked in the marketplace, and you probably have as well, Alexis, the price of UAN is better than urea, so the CF folks and the Nutrien folks may very well want to produce more UAN versus urea, and that would leave those buyers of urea for tons. And unless the price appreciates, it's going to be tough to bring ships in here. I did hear some numbers trade in the first quarter, 715 on urea, and this is all FOB NOLA, and 720 on potash. The next offer on potash is 730. So, put a barge rate on it, where you go to the terminal, the cost to unload and truck, and there you have the price. While I'm on the topic of logistics, I'm sure you guys know this as well. Finding trucks is like trying to find a needle in a haystack. It is so tough. You just can't find them, and it doesn't matter on what commodity. You had mentioned, Brooks, about what other commodities are coming into New Orleans. The steel mills have been printing money this year like they never have before. The price of steel is through the roof. So they import pig iron from Brazil or the Ukraine, iron ore from Brazil, dry reduced iron, and that has continued to come in all year, sometimes 2 to 3 pig iron vessels a month. The steel guys I deal with and talk with don't see this changing anytime soon. And just to give you an idea of what the price of steel has done, if I wanted to build a brand new barge today with covers, $1 million. Now,
and Tom, to kind of put that in perspective, 5 years ago, looking at 350, 340 in that range, is that correct?
No, it was in 2013. Brooks, barges were $475 to $500,000.
Yeah.
So now it's double that to get the same return. We couldn't make work at $475 to $500,000. Now, I do believe this. There were a lot of barges with covers got damaged in the hurricane. Some of those may go to the open top trade. And some of those in the open top trade whose useful life is shaky at best, you can now scrap a barge for $100,000, which we haven't seen that value in God knows when, ever. So you might see the fleet will decrease for sure. And obviously, no one's going to be building new equipment at that price tag.
Tom, let me ask you a quick question, and I'm going to go back and I'm going to show my ignorance here. So, back whenever we put steel tariffs on, Trump administration, probably in the first year, we put some pretty heavy steel tariffs on. My first thought was we're going to kill commerce in the Gulf. It was an afterthought that we were going to increase the cost of barge manufacturing, like you talked about, to the point that it really decreased the numbers that were hitting the river system. So that had an effect. Are those, I'm going to ask, I said, I'm going to show my ignorance here, are those steel tariffs still in place? If they're not, has it contributed to continued lower production of these barges?
Not really. I mean, there's still steel imports. Some of the tariffs are still in place. And of course, the imported price is far less than what the domestic price is here. But we as a country only produce about 115 million tons, and that doesn't take care of our needs here. So offshore tons still have to come in, although because of these tariffs, they're a little bit, they take the steel elsewhere. I mean, they still come in here, and that will continue to happen. But that really didn't contribute to the decrease in building of barges.
It's interesting. We're here. We're corn, bean, wheat folks, some cotton and some rice on here, and we don't think about a lot of those things impacting, our business. What in the world doesn't matter how a steel tariff, how's a steel tariff going to affect corn, beans, and wheat? But we're seeing it right now, where we're seeing a direct effect on what we produce. You mentioned barge freight. Barge freight right now. What is barge freight in St. Louis market? Are we up? In the 6s, 7s?
I think I think the last thing I saw trade yesterday was 750.
750%.
Yeah,
that's a little foreign. Yeah. So that's a little foreign to our viewers, but barge freight trades just like a commodity does. So when we're short supply, that price goes up. Guess what happens to your corn and bean and wheat prices, especially on the river system when it happens? We see that in basis. That's a lot of what Sterling and I talk about, but we're seeing it having a direct impact on the farm right now in my area where we've seen these basis levels fall with big supply of the crop coming in, a little lesser supply of the barges. So it does have an effect on our livelihoods as well.
You know, the one interesting thing this year, Brooks, versus years gone by, because the price of corn and beans at the end of 2020 and January of 21 in the deferred months was pretty good. And a lot of farmers sold a lot of grain, and of course grain freight went along with it. This was the Illinois primarily, and those values were 500% plus, whatever they were. And a lot more freight was sold that early than I can recall in the past. And it was only because the values in the deferred months were so good. So all that freight has to be delivered. Obviously, high price values, there's some volume with them, just plugging in logistic holes on freight that the shipper has booked.
Interesting. So Tom, where do we go from here? I mean, I guess I'm going to ask the scary question because it impacts our yields for next year. Are we going to have enough dry fertilizer to carry us through the 22 crop? I mean, is that a real threat?
I think it's a realistic threat for sure. With so many people vying for tons worldwide, and unless, on the urea front, which is what we need more than, we need the other nutrients as well, as we all know, but that's an important thing. And with the values today, as you guys have all said, there may be some corn acres go by the wayside to go to beans, because the valuation on the commodity price for corn and beans is not escalating in line with the cost of fertilizer and inputs. I don't. Will we find a way? We always seem to. Is it best to book it now or wait and hope the price goes down? I think that would not be a good idea. I think you got to belly up to the bar. This is what I'm going to buy, and get it on the books so you have it. Now, there may be some delays. Let me back up just a second. Historically, the farmer, the retailer, whatever, they wait till the 11th hour to put in their order. And yeah, maybe they get it later than what they would normally get it, but they get it. This year, going forward, because of tight supply, if you have the ability to book something and know you're going to get it, that would be my suggestion. Now, look.
So, Tom, let me stop you right there, and I'm going to ask Alexis to hop in here as well.
Yeah.
One of the problems we've got on the dilemma we've got with retail fertilizer is, and Tom and I have been in the commercial grain business or related to it throughout our careers, and we're prolific hedgers. Everything we buy, we hedge on the other end. Retail fertilizer, that seems to be a gap out there. So the reason why these retailers wait to the 11th hour in a lot of cases is they have to have that commitment from the producer to purchase that fertilizer before they can actually, sometimes they want to take the physical inventory themselves. Tell us how that creates a problem. Alexis, start with you. Do we see any remedy to that? Because, we've wrestled with that for years. I've been on committees to come up with the perfect fertilizer hedge by mixing different commodities as they affect cash prices, and we can't ever seem to get there.
Yeah, no, it's a real problem because the fertilizer market isn't that liquid. I mean, it's still traded by, picking up the phone, calling your buddy and seeing what you can get, and nobody knows that transaction might have happened. This is definitely the year that if you're in the market to buy some fertilizer, I would at the very minimum have a conversation with your retailer and say, this is what I'm thinking of doing today. This is the volumes I think I'm going to need. I'm X% sure I'm going to buy at least 70% of this volume. Give them some kind of an idea of what you're going to need so that they can sort of pencil through on their books, because, the way it works is retailers have to go to the producers and hope that they can get the supply. And, actually some of the fertilizer, UAN is a good example, has already been sold for much of, I would say, the rest of this quarter. So, because we've got this problem in the fertilizer industry on the domestic side where we produce 365. These operators, they want to be constantly running their equipment. So they produce 365, but we're not consuming every single day of the year. We consume a lot in like 3-4 weeks in the fall, and then again for 2 months in the spring. So the market will do all sorts of things to try to manage that supply chain problem. And this is the year where we're so backed up on supply that I don't think that we're going to have quite enough to go around.
So
Well,
not quite,
the other
not
thing
quite as optimistic.
The other
Go ahead,
thing
Tom.
the other thing with the retailer is he can't go bet the farm and hope that the farmers he's been servicing over the years are going to do what they normally do. Just like Alexis said, have a conversation. So, this delivery of the product is obviously a key thing, and what the retailer buys, he may not get when he has it. So I'm sure the retailers are doing their homework as we speak for the spring. But again, the farmer's got to say, like Alexis says, okay, I'm going to buy this, this, and this. Here's my money. Because he wants to expense it in 2021, obviously. But the retailers then got to be able to go to a producer or a trader and say, okay, here's what I need. Can you belly up to the bar and give me? And I don't know. You chime in, or I don't know if anybody can make that. I don't think anybody can make that commitment on the supply side.
Right. Well, and it's tough from the retailer side too. If you look on a volume basis, the sheer volume that retailers do for corn and soybeans relative to the volume that they do on fertilizer. Fertilizer is a very small piece of their overall pie. I think a lot of those retailers approach, doing business with farmers as they want to keep the corn and soybean business because it's a big component of their overall budget. And then the fertilizer is, it's an additional service that they offer to farmers, but it's a smaller component of their P&L. So, in the past, they've always pulled a rabbit out of the hat in order to get it to farmers to keep them happy and to keep their business. You mentioned this, Tom, but I keep hearing this from retailers and producers over and over again. Well, will we be able to meet supply? Well, we always do. We always get it done in the spring. This isn't the year. This isn't the year to take that gamble.
So
I was looking at the spreads. Just one more thing on wholesale ammonia pricing to retail ammonia pricing, and right now it's been running negative for 3 weeks. And what that's telling me is that retailers still have some lower priced fall inventory that they're clearing out, and they're also unwilling to pass on that higher replacement cost to farmers on the ammonia side because it's not going to be a fun conversation to have if you're a retailer to say, hey, ammonia pricing, well, I used to be able to buy it at $700, now it's $1,200, and I have to pass this cost on to you. And if I was a farmer, I'm pretty sure the conversation would go something along the lines of, well, pound sand. I'm not paying that. It's a fun conversation to have. So I do think some retailers have they're trying to resist the price increase, but it's certainly coming. There's more pain ahead.
So, Tom, I'm going to give you just a couple of moments to think about that positive thought to end us with. But as agents, and I want everybody to hang on here. I know everybody likes to hang up right when we get ready to conclude, and we're close. As agents, we offer protection through multi-peril with an average price during the month of February. And we're seeing some decoupling of when that protection comes and when we're getting ready to spend a big percentage of our expense stream. So like Alexis said, I think, Alexis, you were 35 to 41% of some of these decisions are getting made right now whenever we don't have that offsetting protection until February. So in other words, the concern is if prices go down in February, we've spent a lot of money in November and December. Here's where your marketing, your policy come into play. What you can do right now is, and Sterling and I have talked a lot about this, and Sterling, I want you to jump in here. We're going to wrap this thing up in about 4 to 5 minutes. What you can do is just good old-fashioned hedging right now. If you know you're spending X percentage in fertilizer, whether that's you're buying it all or buying part of it, whether it's 20 or 30%, the key is you've got to know. You got to know what that percentage is. You can offset that with some pretty decent pricing opportunities for next year. We saw those beans in a carry situation where prices are a little bit higher for next fall. Nothing wrong with that. Corn, still some pretty good, pretty salty prices for next December. Not a bad time. If you're spending 20% of your expense structure out there, an offset of 20% sales certainly looks like an opportunity. Now, Sterling and we spend a lot of the last few months talking about derivative and option plays. There are a couple of them that you can use for next year, but time value is really what gets in the way of utilizing those right now. There's a couple of advanced strategies that we won't talk about today, but Sterling, maybe it just gets back to the old bread and butter, hedge to arrive, futures only, to help offset some of that risk. To hope and worry right now is not a good strategy. You just heard that from Alexis. You heard it from Tom. Sterling and I are backing that up on the marketing side. Sterling, give us just a few seconds on how you can market this thing to offset your risk. I think you're muted.
Can you hear me now?
Got you now, yes.
Okay. Yeah, I agree. The HTAs are probably right now the best thing you can look at. The second thing that I would look at right now, we've got September corn, which isn't exactly a perfect hedge, sitting at 533. That's going to probably tag along and trade with the December contract. If you were to sell one of those futures, you could probably sell a future and buy a call against this in protection. And that might be one way to kind of offset it. But again, right now the time premium to do the options is frighteningly high. And really the skew is more favor for buying calls right now since prices have declined. But again, it's not too much of a fine-tooth comb. So right now we're kind of in that weird period, and our biggest risk, again, is South American weather, and if we see that improve, we can probably expect these prices for next year to start to struggle.
So we've painted a little bit of a bleak picture. We generally find our way out of these things, like Alexis said and like Tom said, whether it's fertilizer supply, making ends meet on here. But it's going to be a challenge this year. I think we're going to have to make some uncomfortable decisions. We've had the luxury, I don't know if you read the DMO, but sometimes when things come easy, we kind of lose track of some of the basic fundamentals of business management on the farm. And I think those decisions are back in our plate front and center. We're going to have to address some of those shortly. Well, with that, probably one of the best Third Thursday marketing meetings that I've been part of. I have certainly learned a lot out there. And I know we've painted some bleak pictures, but Tom, that's why we had you on here, Tom. So I've given you a few minutes. Give us one positive note. Give us some of that Tom Torretti optimism before we conclude the meeting.
Well, we will have enough barges to supply what will be needed January forward. We're still in the after Ida phase, and that will eventually dissipate. So with all the bulk commodities that come into New Orleans, there shouldn't be any issue with regards to capacity. One other item going into next year, annual northbound barge contracts, fertilizer contracts, probably will increase 10 to 15% on price as of today. For what reason? All of our costs are through the roof. Labor, fuel, everything else.
Yeah.
So I do envision that, but as is always the case in our industry and the fertilizer industry, they're pretty darn resilient people, and they always figure out a way to make it happen. And I don't see that change. Except this year is going to be a heck of a lot more difficult than in the past.
Well, very, very good. The good news is if we've got it, we can move it and get it out there to the country. Well, with that, I appreciate everybody's attention. We had a good attendance for this, and everybody stayed on. Alexis, thank you so much for taking some time out of your day. Tom, same to you. I'm glad we got things squared away. And everybody have a great day. We'll see you next month on Third Thursday Marketing Meeting. Thanks a lot.